This is the Asia Trade. I'm Haslinda. Amin in Singapore.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Asian stocks are set to struggle for direction after Wall Street erases gains, weakening US services data raising fresh concerns about the Fed's policy path. President Trump says he's very close to extending the China trade truce, even as he ramps up threats of new tariffs on chips, drugs and buyers of Russian energy. And AMD shares sliding late trade as a warning on its return to the crucial Chinese market overshadows an upbeat AI forecast.
Well, Haidi, it was a choppy session for the U.S. with the S&P and the Nasdaq giving up all gains for the day. More data suggesting perhaps the U.S. economy is shifting somewhat, with services stagnating, coming on the back of that weaker than expected labor data just days ago, putting into question Fed policy. And speaking of the Fed, we heard from Trump. He says he is expecting to perhaps announce a replacement for Powell by the end of the week. It is down to 4 nominations. Scott Bessent, if you're wondering, is not one of them. He says Scott Bessent says he is happy where he is as Treasury Secretary. And of course, we're keeping an eye on oil. It is currently at 65.25, reversing those 3 days of losses. We had Russia saying that perhaps it is mulling an air truce with Ukraine to avoid that secondary sanctions by the U.S. So lots to consider when it comes to market participants, but when it comes to Asia and the rest of the world, tariffs still top of mind.
What's new has, other than, of course, the possibility of more developments when it comes to what we hear from President Trump. But take a look at the setup when it comes to the equities session. We are seeing a bit of caution, potentially a bit of a struggle for direction this session, as we saw, of course, that rally carry through yesterday. But at the moment, we're seeing a muted sort of picture when it comes to futures trading for Sydney, as well as in Japan and South Korea as well. We did see really sort of conflicting signals in recent weeks, both the eco data that has just went through, but also some of the developments on the trade side there as well. We're watching China assets in particular, given that we've heard from President Trump that he says he's very close to that extension of the trade truce there. We're watching New Zealand as sort of one market that is in focus, with that jobless rate reaching a 5-year high as we continue to see the slowdown in that economy as well has. But of course, as you say, it is all down to trade.
Well, that's right. We have pharmaceuticals as well as drugs to consider. Trade continues to dominate the headlines, with President Trump threatening new or higher levies on countries and products, while some U.S. partners continue negotiating better deals. Swiss President Karen Keller-Sutter is in Washington, pushing to lower the 39% tariff imposed last week. Japan's chief negotiator is also traveling to the U.S. in pursuit of promised cuts to auto tariffs. Meanwhile, Trump says he'll announce levies on pharmaceutical and chip imports in the next week or so. He's also threatening increased tariffs on countries buying energy from Russia, including China, after saying he'll raise levies on India within 24 hours. Let's break it all down, bring in Bloomberg's digital politics editor, Romy Varghese, and Asia Pacific economy reporter, Swati Pandey. Romy, let's start with you. What is the main sticking point between the U.S. and China in tariff talks?
Yes, U.S. officials, even Trump, have voiced some optimism about the China talks, but a key sticking point is rare earths. These are crucial components that are used in everything from home appliances to missiles. And the United States want to see exports of these rare earths increase. And that is the key sticking point. And they want to have a commitment from China that they will ease their restrictions on these rare earths.
And of course, the the India story continues, right? Trump wants to penalise India when it comes to these Russian crude purchases. India says this is a structural element of their energy needs. How does this go down with sort of a strongman leader like Modi?
Yes, it was quite surprising the way it has unfolded quite publicly. These assaults have not gone down well in India. It looks like India will react but not retaliate. India would want to discuss discuss and negotiate with Trump and with U.S., but at the same time, India has a strong relationship with Russia, and Indian officials have come out to say these words, in fact, that its ties with Moscow is time-tested. They have said that the criticism from Trump is unjustified and unreasonable. So India is holding its ground so far, but it will government would want to negotiate with Trump and come up with a solution.
Remy, when it comes to US tariffs on chips and pharmaceuticals, these sectoral tariffs, can they hold up when it comes to some of the legal challenges that are ongoing?
Yes, experts are telling us that some of these tariffs are going industry by industry, like semiconductors, pharmaceuticals. They actually have stronger legal ground than these country-by-country tariffs. And that's because Trump is using a part of the law that says that these tariffs are needed for national security grounds. So that is why you're seeing reaction from companies, from pharmaceuticals to semiconductors, companies that rely on semiconductors. They're very concerned about these tariffs because they seem to be more likely to go through than these country-by-country tariffs.
I guess the great focus is actually on drugs, given that those tariffs could rise to as much as 250%. I mean, how might this play out in the market?
Well, yes, Trump threw out some interesting numbers and also gave a pretty vague timeline. But what we can say, is fairly possible over the next week or so. There will be a really hefty tariff, might not be 250%, but a hefty tariff that pharmaceutical companies do not want to see. And the reason Trump says he wants to do this is because he wants to boost domestic production in the United States. Unfortunately, the current situation is that much of production is outside of the United States. I mean, nearly 90% of biotech companies, U.S. biotech companies, rely on imported components for about half their products. So ramping up domestic production, it would be a pretty difficult feat in the short term. And so we are going to see companies and then ultimately customers face these higher costs.
And Swati, we know that India is trying to contain the fallout. It's trying to help all the segments which will be impacted by the tariffs. In terms of the RBI, which is expected with its decision later today, what can it do?
The majority of economists in Bloomberg survey expect the Reserve Bank will stand pat today. However, some economists have brought forward their easing. The RBI has already cut interest rates by 100 basis points this year, and it's estimated that it's somewhere close to neutral rate, where policy is neither stimulatory nor contractionary. So it does not really have a lot of room to go further down. But yes, easing monetary policy is one of the ways to resolve some of the economic pains that India may go through if it indeed gets 25% plus additional tariffs or penalties.
I guess part of the reason why markets have been sort of so complacent about the tariff risk is that we've yet to see, except perhaps in the US over the past sort of couple of weeks, the indicators pass through. Is Asia holding up as well?
It does look like. In fact, exports have been pretty strong. There were fears that Singapore may go into recession. Did not happen. Outcome was a lot better than expected. And we are seeing that in other export-oriented economies in the region as well. Inflation is also under control. It's probably likely that this whole tariff situation will not be inflationary for Asia. So in that sense, central banks can focus on growth, provided that inflation remains within their target range. So yes, I mean, so far it does look like things are fine, and which is why we are seeing that complacency in markets. But 2026, I think, will be the year where we will start seeing impacts of export, import, trade diversions, inflation. All of it will start to play out then.
You just kick that can down the road for a bit.
Especially, Swati, when a lot of Asian economies are dependent on exports. I mean, how big might the impact be on Asia in 2026, you think?
It is. So there are several estimates from economists, and Asia looks like it will be really badly impacted. And that is largely, as you say, because it is an export-oriented economy. So it does look like globally Asia could be one of the biggest impacted region. All countries are trying to find newer markets. They are trying to diversify. But then U.S. is such a large consumer. China is a big Asian market as well. So there are fears that China might be dumping its goods in other parts of the region if it doesn't get that much demand from U.S. So there are a lot of moving parts at the moment. But certainly it does look like Asia will be impacted, even though the actual tariffs that have been announced in the past week were lower than what was initially threatened on Liberation Day.
Bloomberg's digital politics editor, Rami Varghese, and also our Asia-Pacific economy reporter, Swati Pandey, there with the latest on trade. And let's get more on how investors and markets are reacting to these latest developments. Our equities reporter, Nora Melinda, joins us now. So let's start off with the Fed first. Of course, there's both sort of the threatened politicization of the Fed, but also the latest eco data that has really changed expectations of what the path forward for easing looks like.
Most definitely. I mean, today we did see stocks ending lower, of course, as you mentioned, on the back of that weak economic data that we got. We really saw a deterioration in ISM services data, and that's really pointing toward tepid demand and rising costs. But if you think about that in the context of the weak job report that we got last week on Friday, it's really just illustrating and underscoring a lot of these concerns that people have, especially as it relates to interest rates more broadly and what the Fed's next steps may entail.
We know that Trump is considering right now his choice for Powell's replacement. Take a listen to what he had to say.
Fed governor, I'll be making that decision before the end of the week, and we'll either decide on one for permanence or the 4-month period, the term. There's a term of about a number of months. We have a couple of candidates. Everybody wants it, okay? It's not a couple, but we've narrowed it to a couple of candidates. And we've also, we're looking at the Fed chair, and that's down to 4 people right now.
Nora, we know that Fed credibility is front and center when it comes to the markets. How is this playing out in terms of sentiment out there?
Well, it's definitely making an uncertain environment, of course, especially when people have really gotten to know Jerome Powell. But I do believe that there is a lot of angst from investors. They're looking for rates to come down just as much, as maybe President Donald Trump does as well. But Trump has made it abundantly clear that he is looking for that to happen, and he's looking for somebody that he can put in that position to do it. Of course, we know Scott Bessent has said that he does not want to replace Jerome Powell. But of course, we do know there are other names being floated about who could be the potential successor here in this situation. But it really depends, because of course this is potentially the Fed chair, but of course it really is a broad decision that is made when it comes to adjusting rates here at these meetings.
We've also seen the latest meme stock rally kind of play out as well. What does that tell us about sort of investor mentality and psychology at the moment?
Well, we've definitely been seeing a lot of investors running toward the more speculative corners of the market. We saw a rally in Open Door Technologies, which is a digital real estate stock that's really been beaten down, even trading below $1 in recent months. But we are seeing that really spreading and showing that even though we are working with a market that's sitting here at all-time highs, we have investors that are really looking for more. They're looking for more opportunities. So while there are a lot of headwinds out there as it pertains to the economy and geopolitics, and of course, these trade concerns, we definitely have investors that are optimistic and really looking for opportunity in some of the corners of the market that aren't necessarily always thought of.
Bloomberg's Nora Melinda, thank you so much for that. Coming up on the Asia trade, Mizuho Bank and DBS will be sharing their insight on the U.S.-India trade tensions and how it could factor into today's RBI rate decision. But first, Russia said to be considering an air truce with Ukraine to head off Trump's threats of secondary sanctions. The latest on the push for peace next. Keep it here with us. This is Bloomberg.
I never set a percentage, but we'll be doing quite a bit of that. We'll see what happens over the next fairly short period of time. But we'll see what happens. Yep. You know, they have a meeting tomorrow. We have a meeting with Russia tomorrow. We're going to see what happens. We'll make that determination at that time.
President Trump, they're also saying that he's now considering additional tariffs on countries that are purchasing crude and energy supplies from Russia, including the likes of China. Trump saying that he never set a percentage that he would impose on Russia's trading partners after previously having mentioned tariffs at around 100%. Of course, so much of that is sort of on Indian exports as well, saying that they're fueling the war machine by buying Russian oil. At the same time, though, we are seeing oil falling for a fourth consecutive session. We're seeing New York crude picking up a little bit at this part in the session, but broadly that downside coming as Russia weighing concessions to the US that could potentially include this air truce. So this is something that Bloomberg has learnt in terms of what Russia is mulling at the moment, a concession to President Trump, possibly in the form of an air truce with Ukraine to avoid secondary sanctions. But also say President Putin won't agree to a general ceasefire as his forces continue steady advances on the battlefield. Our Bloomberg editor Michael Heath has been following the latest developments for us. So what are we hearing that's being contemplated, and is it meaningful?
Yeah, I mean, look, it's meaningful in the sense, Haidi, that Russia's been basically, I mean, it's been, bombarding Ukrainian cities and targets and that sort of thing. So, I mean, it's been for the civilian population, an air truce or an end to these sort of bombardments obviously would be really important. But it's really not enough. I mean, what Russia's trying to do, what Putin is trying to do is sort of a classic play, is throw the US a bone so that Trump's got something to parade that he got from this threat of sanctions without changing any of its underlying course. Now, you'd think with President Trump that it's finally become clear that you wave the big stick at Russia and you immediately get a reaction. So oil is the lifeblood of Russia's economy. It finances the government. The wealthiest people, Putin's elite, are all involved in the oil industry. So that's what you want to target. So it'll be interesting to see whether the US accepts this bone that's thrown to them or whether they demand more, because they are in a position to demand more. And Ukraine is on the back foot. Russia is advancing everywhere. And the Ukrainian population, I mean, they've been under these bombardments as well. Their morale is probably not great as well. So it really comes down to what the level of resolve is in the US there.
Meantime, Mike, Israel mulling a full takeover of Gaza, but not everyone's in on it.
Yeah, well, that's right, Haslinda. I mean, there's division. Our reporting has this division with the military, which I guess there's a degree of scepticism about how much more can be achieved, and what this will actually bring, and even among the population in Israel, there's no longer majority support for the government in sort of what it's doing in Gaza. So, I mean, they're looking to occupy the remainder of it, and obviously to try to get these 20 living hostages, what's believed to be 20 living hostages, left out. But, the military, there's no real military solution here, and I think it's fairly clear to everyone. And the other problem for the Israeli military is these reservists who have been called up have basically been fighting for nearly 2 years straight now. They're exhausted, and the more extreme parts of the government, it sort of is immaterial to them, but they hold the balance of power, so they want to keep driving the whole military side, in terms of Gaza, and they keep the government, Prime Minister Netanyahu, in office. So there's a bit of a conundrum there. I mean, on the other side, Hamas isn't backing down either. So, if they walked away, then obviously a peaceful solution could be found too. So it's a bit of a Gordian knot there at the moment, but it's really hard to see how occupying more is going to bring some sort of resolution here. What it does look like is that Israel is going to sort of take control back of the Gaza Strip in some way, shape or form.
Bloomberg economy editor Michael Heath here with the latest. And coming up next, AMD leaves out sales of AI chips to China in its latest forecast. We'll be unpacking those earnings with Bloomberg Intelligence next. This is Bloomberg.
Welcome back to the Asia Trade. AMD shares fell in post-market trading as it warned that a return to the crucial China market remains a work in progress. That overshadowed a generally upbeat forecast for its AI business. For more, let's bring in Bloomberg Intelligence senior semiconductors analyst Gunjan Shobani. Gunjan, good to have you with us. You know, China, of course, the biggest market for semiconductors, billions of dollars at stake here. So not surprising, investors are nervous.
Yeah, I mean, fundamentally, there was nothing majorly wrong with the print and the guide. The non-AI businesses did really well. PCs, they continue to gain share. Even in the data centers on the server CPU side, the company showed really impressive numbers and continues to gain share. But the focus right now, it is on the AI GPUs. So there was expectations that the lost China revenues would be coming back soon in the second half, probably starting from 3Q. Estimates varied from 500 million to $1 billion. What they said today sort of would bring that out of the numbers or reduce that expectations, which I think investors didn't like. And secondly, they again did not affirm a number for the full year or a guideline for a 2026. And the expectation has been running high since their last AI day, as we saw the stock run up since then until the earnings. So I think those two factors on the AI GPU side would have dampened the enthusiasm.
They're confident about the AI market, but kind of very sort of cautious about the specifics, right? What's the runway for growth and the outlook?
And the runway continues to be positive. There's nothing that they showed or said that should distract from that. But, with AMD trying to get that number 2 spot and getting share against Nvidia, it's the investor expectations. We saw the same thing happen last year. Always seems to be running a little bit high and running a little bit on the speculative side. And when the company comes and shows steady progress, typically not affirming the really lofty numbers, we have seen this kind of reaction to the stock happen time and again when it comes to their AI GPU numbers.
How much more upside for the stock? 44% year-to-date so far.
Yeah, like most of that upside, like I said, was driven through the increased enthusiasm, which still remains intact, that they are gaining much more adoption across their AI GPUs, whether it's state hyperscaler, whether it's neo cloud, whether it's sovereign. So that rally was driven by that, again, incrementing enthusiasm. The numbers for near term might not have come in as people expecting lofty, but the underlying enthusiasm still should be remaining for the long term.
Bloomberg's Gunjan Shobani there with the latest on AMD as we continue to watch how a lot of these trade tariff sort of headlines continue to play out when it comes to the start of trading in the next hour across major markets here in Asia. Looking pretty cautious and perhaps looking for direction. Sydney futures still in the green, about 0.1% higher, but we're looking like a pretty mixed open given a muted picture when it comes to Chicago Nikkei futures and S&P futures looking a little bit to the downside as well. We do have that weakening US services data that came out overnight, fueling yet more uncertainty about the Fed's policy path going forward. Some choppy trading could be expected. More ahead on the Asia Trade. This is Bloomberg. Let's take a look at some of the latest data from Japan, particularly when it comes to that key element of wage growth, that puzzle piece that the BOJ continues to look at, particularly when it comes to boosting household confidence and closing that gap with rising inflation. We have June same-base regular full-time pay gaining 2.3%. Cash wages from the same sample seeing a gain of 3% year-on-year, but real cash earnings falling 1.3% year-on-year. That is worse than estimates of a 0.7% contraction. So a year year-on-year estimate, year-on-year, I should say, gain when it comes to that headline number of 2.5%, also missing expectations of 3.1%. There have been expectations that we will see stronger wage gains, particularly in light of the progress being made in the Shunto spring wage negotiations and the account for perhaps bigger summer bonuses, but that's not being played through when it comes to these June cash wages numbers that we're getting across the Bloomberg. Still, though, the expectations are potentially for the BOJ to move a little bit quicker, and we've got the likes of MUFG amongst Japan's big mega banks calling for an earlier Bank of Japan hike to tackle inflation. Take a look at what we're watching when it comes to US stocks, though, because it was quite a little bit of a worrisome session for investors given the weakening data that we continue to see. But at the moment, we're seeing S&P futures looking pretty flat.
Well, that's right. Lots of questions about what the Fed does from here as well. The big question in the market. Let's bring in Vishnu Varathan, Head of Economics and Strategy at Mizuho Bank. Vishnu, good to have you with us. You know, when you take a look at the data, increasingly you get a sense that perhaps there's a shift in the U.S. economy. First, it was the labor data. We could expect it now. It's services. Is there a sense things have changed?
Well, I think we always took a view that, you know, the household cash flows were tightening up. So as a result of that, you were going to get softer outlook coming through. And I think with the corporates as well, our sense was that the hiring intent was somehow less aggressive at the very least. And now it's turned cautious, which is why sometimes you get numbers that suggest that hours being worked are longer, but that may be getting more out of what you have rather than hiring more. So yes, there is a softening in the data, but there are two fair warnings here. One is there's a lot of distortions due to the tariffs, anticipation of which means corporate behavior is different, front-loading, so on and so forth. Consumer behavior could also be different insofar that consumers who are watching these headlines, it's hard not to look at the elephant in the room, might front-load some spending saying, you know, I'd much rather take on inventory that is not tariffed yet than take on the cost later. So the data would be bumpy. And the second layer of uncertainty is, but it still doesn't take away the problem that simultaneously you could have a price shock. And then you end up with the Fed that still sits on a sharper dilemma, but a dilemma nonetheless. So it doesn't distract from the Fed's dilemma, but it does point to the fact that we probably need to actively look at two-sided risks rather than just focus on prices alone.
So data is weakening, and that's even before you factor in the impact of tariffs, which will come, Powell says, at the end of the year. So Powell could be wrong. He could be too late in the game.
I'm glad
Trump could be right.
I'm glad you brought that up, Haslinda, because to your point, the tariff effect will come through later. But the real question around that is that durably inflationary, or is it actually ultimately deflationary because the consumer ends up having to dish out more cash but end up consuming less, hence starts to pull back in terms of the quality of consumption or quantity of consumption. So those are the things that we don't know yet. And I think that's really what Powell is alluding to. He doesn't know what the outcomes are. And to be fair to Powell, I don't think he wants to be late, but he has suggested the direction of travel for rates is lower. It's just that given the uncertainty and the things that keep moving all around, he doesn't know which way to go yet. My last point on that is pausing is not a static thing. As time passes, the economy weakens further. So your response function needs to be there. So by pausing and saying we're assessing, you are actively, perhaps, possibly weakening the economy further than you have to. So that's a point that we must be cognizant of.
In the meantime, we've seen data for the Asia-Pacific holding up pretty well, right? And we've seen central banks really kind of be able to focus more on growth in this part of the world. There are some exceptions. How much pressure is the Indian economy going to come under as we look to the RBI decision? Is there any way out in terms of that structural relationship with Russian crude?
I think, Haidi, that's perhaps the question on every Indian policymaker's mind. We probably, for context, we have to put this in place, which is the imports of Russian crude goes well beyond the net trade balance involved. It is integral to the economy because the economy needs low-cost energy to supply and broaden growth out, which is why it becomes a painful decision. That kind of informs us why India has pushed back so hard as well, rather than just conceding. But I don't think the RBI has a solution here. There are two parts that need to work. One part is because the Russian crude imports were ramped up so quickly from almost being a negligible share of India's crude imports pre-Ukraine war, it's come up to about 38%. Surely they can pare that back as a negotiation, but they might want to keep that option intact. Whereas the RBI has rightly front-loaded its cuts. Probably the best position to be is to pause right now, because the RBI doesn't want to compromise the rupee further at this point. That would just add to the stress rather than easing. So the trade-off in terms of getting some easing for the economy versus rupee instability suggests that the RBI should hold, even though they've got scope to ease a lot more. And I think that's what the RBI will stick with, especially after the 50 basis point cut where RBI shifted to neutral stance. They probably wouldn't want to backpedal on that too quickly.
At the same time, we're also watching these sort of extended conversations about an extension of the truce with China, right? Is it interesting to you that they kind of seem to be happy to kick the can down the road for what is probably the most complex of these trade and strategically competitive conversations?
I mean, it's not at all surprising. I mean, China just came out saying, I've got swag and I'm not afraid to use it. Sorry, did I say swag? I meant leverage. So clearly we saw that this is not the Trump 1.0 China who's willing to concede and say, let's get on with business as usual because we hope things will revert. This is a China that's realized there's no reversion, and there's a certain element of industrial survival and so on and so forth. So they're going to push hard, use every leverage. And I think the U.S. now knows that there are some buttons they can't push yet, which is why there's an extension, there's further concessions, and there will be some sort of a compromise. But structurally, the U.S.-China antagonism is not going away because in the background, we do still see tightening on chips, so on and so forth. So that we can't get distracted. But what we need to be aware of is perhaps the U.S. will not go all out to hit China because the very near-term impact on market stability, particularly long-end yields, is not going to augur well. And the Sell America theme is something that they wouldn't want to push the envelope on too much.
China has swag. It also has a lot of liquidity along with the U.S., right? So that means the markets will be well supported. Is that a fair assumption?
I would say that the markets will be well supported, particularly given some of the optimism around the stimulus they're putting in place, backstops, so on and so forth. But let's not forget the fact that China is coming from a place of weakness. There is that property market overhang that doesn't go away. Near-term fiscal backstop to get demand going on the household end, not quite a done deal. I mean, it's a great start, but it's a 1,000-mile journey. Baby steps are important, but they haven't concluded the game. And I think on the industrial end, China has got some edge, but needs to really keep that edge. And that's probably where I think the policy trade-offs come, because between financial stability and providing sufficient credit, that trade-off hasn't gone away. We just need to look at how the reallocation plays out as we look at China.
Vishnu, great insights. Always very candid. Vishnu Varathan, Head of Economics and Strategy at Mizuho Bank. Heidi.
Let's take a look at the morning calls ahead of the Asia trading day, and Double Line Capital says the dollar is primed to fall even further. Portfolio manager Bill Campbell says potential catalysts include a weaker US economy and a new Fed chair who may be willing to cut interest rates quicker. He says the dollar has entered a multi-year decline. Scott Rubner of Citadel Securities says that fast money investors will likely reach full exposure to US equities by September. Systematic funds, which typically let factors such as volatility or momentum dictate their exposure to risk, have been piling into US stocks. Rubner says they could sell as they become exposed to market shocks. Much more to come here on the Asia Trade. This is Bloomberg. Taiwan prosecutors have arrested 6 people suspected of stealing trade secrets from TSMC, sparking an investigation into what could be a serious breach of national security. Our China correspondent Amin has more on this developing story involving one of the most critical tech companies. So this comes amid a tightening tech race as companies in the US and China really battling to develop smaller and more powerful AI chips. What do we know?
Yeah, that's exactly why we need to pay attention to this story. And right now we know that Taiwan authorities had arrested 6 people after TSMC shared their suspicion with authorities. We know that Nikkei had previously reported that that TSMC had already fired some employees over suspicion that they are trying to steal technology related to the 2-nanometer chips. These are the most cutting-edge chips that TSMC is able to produce now. They plan to mass produce it in the second half of this year. At this point, it is not clear what the intention of the people stealing those technology is and who they're planning to share the information with. Authorities are still trying to figure out if the information had already been leaked to third parties. But of course, this case is, as you said, coinciding with the race, the tech race there. There are many companies who would want their hands on that information. There are these Chinese companies like SMIC that can now produce only 7-nanometer chips. There's also Intel that's trying to catch up with TSMC as well. There are the downstream companies. We know that TSMC supplies to Apple and Nvidia. There is other AI companies like DeepSeek, like Meta, that want their hands on these sort of technology as well. But of course, against this backdrop of the US-Taiwan trade talks going on, as well as Taiwan tries to negotiate lower tariffs for its goods, the 20% tariffs, and also try to avert those potential sectoral tariffs that could be imposed on semiconductors as well.
At the same time, Min, U.S. is charging 2 Chinese nationals for an export control breach involving Nvidia chips.
Yes, these 2 men had been charged with exporting these chips, Nvidia chips, specifically those H100 chips as well, to China without obtaining the necessary government licenses. And authorities had investigated the phones of these 2 people who were charged and found evidence of communication showing that they were looking to ship these chips to China via Malaysia. And they could be charged, they could be sentenced to up to 20 years in prison, according to the Justice Department. And again, this comes as U.S. and China are looking to potentially extend the trade truce. This is another sort of snag that could potentially derail those trade talks, as China has also expressed concerns about relying on Nvidia chips from the U.S., citing how the Trump administration has been looking to include these sort of location trackers in the chips to ensure they don't fall into the wrong hands. And suddenly this time, the breaches by these 2 Chinese nationals going to be another sort of ongoing contention between the 2 sides as well.
Min, thank you for the update. Bloomberg's China correspondent, Min Lo. Now, shares of German auto chipmaker Infineon climbed in Frankfurt as the company said it would take less of a tariff hit than expected, while also forecasting stronger margins. CFO Sven Schneider told us more about their strategy in the key Chinese market.
The number 1 position we are enjoying in China is a very strong one, which we are also defending. How is that possible? First of all, you have to have the right products. Secondly, you have to continuously invest into innovation. And we have here some very good examples on very new technologies, but also on pretty mature technologies like low power, mid-high power MOSFETs, where the next generation brings our customers 20-30% efficiency gains. The product to system approach, where we are not simply selling pieces and components, but a full system to a customer. These are things which keep us at a distance to international and also Chinese competitors. But you are absolutely right. The speed with which innovation is happening in China on all ends is mind-blowing. We are responding to that very successfully. That's why we are designed in not only in international, but also in the top leading and emerging Chinese OEMs and tier 1s. But we have to keep going. And I also have to confess, and that's no news, we have said it repeatedly, there are also certain product categories, we call it commodity products, low power products, where we are losing intentionally market share, given that the business is no longer profitable enough for us. That's also part of the journey, but enjoying the broadest product portfolio is a very, very big differentiator for us going forward.
And another part of the journey is not only innovation for you, it has also been inorganic growth, acquisitions. I'm thinking of Marvell Technologies over in the United States. When you think about the long-term strategy at Infineon and you think about other acquisitions in the future, what kind of category of activity is still missing in your portfolio? Where would that come from?
So first of all, I'm happy to share with you that the Marvell Automotive Ethernet acquisition, after a pretty short time, has received already all regulatory approvals. So we expect this transaction to close in the near future, which is good news. It strengthens our microcontroller business on the automotive side, but also beyond automotive, it opens new opportunities for Infineon in adjacent fields like humanoid robots. So that's very positive. M&A is always and has always been an important part of Infineon's growth journey. International Rectifier, Cypress, GaN Systems, Marvell, and we will keep looking into opportunities. They have to fit, of course, clear criteria: strategic fit, financial fit, very important, cultural fit, because many transactions are healthy and good, but they do not materialize because culturally it doesn't work together. And of course, we are looking into areas, for example, to mention sensors or software, where it could be interesting to enlarge our portfolio even further.
Infineon CFO Sven Schneider there, speaking with our colleague Oliver Crook. More ahead on the Asia Trade. This is Bloomberg.
Honda will be reporting first quarter earnings later today, with focus on the potential tariff hit to its U.S. profits. Let's bring in Bloomberg earnings specialist Reina Sasaki. Reina, what are we expecting from today's earnings? I mean, we know that Honda's full-year profit guidance looks pretty conservative. What's driving the outlook? Is there upside?
Yes, so Honda's first quarter operating profit will likely decline year on year today. Stemming due to the stronger yen tariff impact and sluggish sales in Japan and China, despite a strong demand in the U.S. The Honda's 500 billion yen operating profit guidance for this fiscal year is down nearly 60% from last year's 1.2 trillion yen. The drop reflect net 450 billion yen of tariff impact stemming from the recently adjusted 15% duty on Japanese cars. So that's softened from the feared 25%, but still major jump from the prior 2.5%. So Honda is playing it cautious, layering in a stronger yen, higher expenses, R&D expense, and sluggish sales in Japan and China. But with U.S. demand proving resilient and price hike helping offset the tariff headwinds, analysts see its upsides. The consensus now shows that consensus now sits at 896 billion yen, which is nearly double the company's guidance. So it can be the classic case of Honda under-promising, potentially setting up for a beat.
Of course, all of this against a backdrop of U.S. tariffs. Are we seeing the trade war reshaping Japanese automakers' strategy?
Yes, that's a great question. So tariffs are already reshaping the map. Honda expects a gross 650 billion yen of tariff hit this year, but it's actively countering, restoring production, localizing part sourcing, and passing through higher costs. So this trimmed the net impact to 450 billion yen. But the game is broader. The Goldman Sachs estimates the new 15% duty could cost Japanese automakers 1.9 trillion yen, with Honda among the most exposed given its U.S. footprint. So market reaction will hinge on how quickly it can execute localization while preserving margin. And it's a delicate balance of retaining pricing power without ceding shares to Korean and U.S. rivals.
Bloomberg earnings specialist Marina Sasaki there. Let's get you the latest when it comes to some of the corporate headlines we're following. And Amazon will offer OpenAI's latest models to customers on its Bedrock and SageMaker platforms. OpenAI says the newly unveiled models can perform complex tasks like writing code and looking up information online. But until now, Microsoft was the only cloud provider reselling OpenAI software as an advantage that has helped its Azure division grow faster than AWS. Nvidia and Apple partner Hon Hai saw its July sales slow by 7.25%, marking the weakest performance since January as tariff concerns hit electronics demand. Still, Hon Hai is expanding its US server production, betting on big tech spending more on AI infrastructure. It may also have gained from strong iPhone demand, as Apple reported its fastest quarterly revenue growth in more than 3 years. BP shares rose in London after second quarter earnings easily beat expectations a day after it announced an oil discovery off Brazil. That's its biggest find in 25 years. But CEO Mario Oceancloss is pledging that the company can and will do better as it launches a review of its businesses and costs. He also told us that he's upbeat about overall energy demand.
Demand remains pretty robust, if I'm honest, despite all the headlines. 1% growth in demand over the past 20 years or so. 2025 looked like 1% demand growth. 2026 looks like 1% demand growth to us from different sectors, from petchems in 26. But demand growth continues to be strong for the product.
Tesla posted another steep sales decline in Europe as it loses ground to China's BYD. July sales in Germany and the UK fell by more than half from a year ago based on EV registrations. By contrast, BYD's registrations more than quadrupled in each country. The ongoing slump adds to concerns that Elon Musk's political activities are hurting the brand.
Well, Haidi, checking some of the stocks to watch when trade opens in Australia, Korea and Japan very, very shortly. If the trade in the U.S. is anything to go by, then it could be a choppy session because of the data out of the U.S. services stagnating. Of course, we had the weaker than expected labor data out of the U.S. as well. Right now, we're seeing pharmaceuticals under pressure. Of course, Trump talking about, tariffs going as high as 250% within a period of 12 to 18 months. Asian pharmaceutical companies that sell products in the U.S. may just move on the back of what Trump said. For drug imports, they would be announced in the next week or so. And keep watching Asian chip makers on Trump's latest tariff threats, along with AMD's warning. Keep it here with us. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens. Take a look at how we're setting up. And it is sort of a mood of general caution, perhaps searching for direction for Asian markets as we have a number of headwinds to contend with, from the sort of future of leadership at the Fed to, of course, some of the further weakness in the data coming out from the U.S. overnight. Again, kind of reshaping traders' expectations of what the central bank might do in terms of sooner than expected easing. We're also looking at the latest trade threats as well, particularly pertaining to the likes of India over the Russian crude purchase issue, but also potentially additional tariffs that President Trump mentioned against other purchases of Russian energy, including China. S&P futures falling about 0.1% at the moment. We're seeing NASDAQ futures off by just about 0.3%. Also watching the US dollar, the Bloomberg dollar index there as well, seeing some softness. We have had really some strategists saying that we're in the middle of sort of a multi-year weakness for the dollar. Take a look as we head into the start of trading, of course, in Asia markets proper. Nikkei 225 off by just about 0.3%, reversing some of those gains that we saw in the previous session. Some of the uncertainty over the timing of the Fed's next rate cuts, along with sticky signs of inflation, weakening economic indicators, all at play there. We also had wage data from Japan that came in a little bit softer than expected, given that nominal pay rose a bit faster, and that may be enough actually to back the case for a BOJ rate hike, perhaps even sooner than expected. 147 is where the yen is trading at the moment. Switch out the board to take a look at Korean equities to see if they're sort of following the track that we're seeing along with the rest of the mood music. We are seeing the Kospi off by just about 0.5% there, and the tech-heavy Kosdaq index also seeing some losses there as well. Watching chip stocks as well. We're watching the likes of the TSMC leak probe as well as some of the AMD's woes in the Chinese market as well, and that could play through to some of those Asian chic names. Taking a look at Australia now, New Zealand is actually one that we're watching today given some of the downside in the labour market data there. The jobless rate sitting at that 5-year high, just further indication that the economy there is slowing for various factors, the highest since the third quarter of 2020. So really the sign of an economic slowdown that could prompt the RBNZ to move even faster. Finally, we're continuing to watch oil, given that we've had a fourth day of declines for crude prices more broadly. A little bit of a pickup in the New York session, but of course so much focus on the potential air truce when it comes to the Ukraine and Russia situation, but also these threats on India over purchases of Russian crude. Let's bring in now Carol Schleif, who's a Chief Market Strategist at BMO Private Wealth. So, Carol, it feels like there's a lot of conflicting factors for investors at the moment. What's top of mind for you?
There's a lot of things going on, and we've been warning clients for the last couple of weeks in particular to take August into early September with a grain of salt, because it is a month when you've got a lot of people on vacation. Congress is out of town. It's potentially very headline driven, and we've seen some of that, especially with the economic numbers coming in and markets reacting seemingly strangely between Friday and Monday. But a lot of that has to do with the light volume that's out there. And so we've been warning clients to try to look through and past that and stay focused on the fundamentals. And as we've seen from earnings season so far, the earnings fundamentals and the company fundamentals are coming through by and large pretty decently.
Where do you see the opportunities at the moment then?
I think the opportunity is to stay calm, rebalance to the extent that one wants to. There's still a lot of interesting things going on globally. We continue to lean into the growth story, if you will, particularly as the large cap names continue on there, because it's important to remember. Even your own analysts have noted that the hyperscalers, the plans for data center construction and small nuclear reactor construction and plans there, and infrastructure spend is up hundreds of billions of dollars between this year and next year. So there's a lot of activity going on there, aside from all of the policy whipsaws that we're all getting. It's hard to peg those through, although we've gotten more guidance from companies as the earnings have come in, exactly how tariffs have already hit, what they're looking for. They're having to be pretty circumspect about the way they communicate it, if you will, but companies are absorbing it pretty well. We are watching very closely consumers, but suspect we're hopefully close to or past the worst of that piece, especially if we get some of that spending that we anticipate in the back half of the year or going into next year, seeing more stability, hopefully, and firmness in the labor market in particular.
There's also concerns that 2026 is where we'll start to see the actual pass-through of the tariff and trade effect, right? Is that a risk for you?
It is a risk, and it's important to parse through, because I think one of the things that was concerning about some of the economic numbers out today, and the thing that people will watch, is manufacturing obviously is a very small part of the U.S. economy, and services is the predominant part. The fact that we saw some bleed over already of tariff impact or on the second or third order potentially into the services market is something we're watching carefully. But we do suspect, once you start getting, now that we've got more clarity with the One Big Beautiful Bill Act being passed, and we've got businesses know that they can do immediate expensing of some of their R&D. We're seeing M&A and IPOs pick up. There's a lot of things that could potentially sway it to a more positive tone, particularly in the back quarter of the year as we look into next year. And we do suspect going into next year, too, you've got more muted expectations, which as companies have brought them down, they're very focused on trying to maintain margins. There might be some bleed through in particular cases, but we also think that consumers and businesses are pretty good at substituting for other things. So we think in the long run that the economy should be able to absorb it.
What do you make of the risk presented by the uncertainty over Fed leadership at the moment?
There is that piece, but we think a lot of the headlines in the media makes more out of it necessarily than the Fed does, or than investors do, particularly in the fixed income markets, because we do think the FOMC is comprised of, I think it's 11 or 12 members and voting members. They're very focused, and the broader Federal Reserve is very focused on making sure that they're apolitical, if you will, and following through, because the credibility of a central bank is vital, and markets know that and understand that. The ability for President Trump to swap out a couple of Fed governors should not theoretically impact the rest of that committee or the voting committee, although obviously there'll be influence and pressure at the margin. But President Trump has advisors in his administration, like Treasury Secretary Scott Bessent, who understand the criticality of an independent Fed, and we do think that wins out in the intermediate and longer term. And bond markets have been pretty orderly, telling you that we haven't had our own Liz Truss moment yet, so hopefully that doesn't ever come. But bond markets are keeping a pretty close eye on things and holding politicians, not just here, but around the globe, to account.
Judy, what are the expectations when it comes to bond markets, right? Because in recent days, we've sort of seen a little bit of a calming, at least on the longer end, that we've seen play out over the past few weeks.
I think the bond markets have reacted both to presuming, I mean, we have seen it factored into the market, assuming sooner start to the rate cuts, because prior to some of the economic stats today and Friday, most of the futures markets were discounting out to September. Now or out beyond September. Now you're seeing a much higher likelihood and or potentially more cuts being factored in this year. And the fact that Treasury Secretary Bessent has said repeatedly he doesn't intend to extend out the funding of the government, if you will. They're going to keep it funded, keep rolling bills and not pushing things further out. And that's reassured, I think, the fixed income markets as well. And you're also seeing relatively tight spreads between the high yield and the investment grade, which is constructive as well of an economy that is by and large functioning well. It's absorbing things. The capital markets are behaving like they should, and it's lending some reassurance to things. But we are encouraging investors. I wrote a piece just last week on tracking the 10-year, or I co-wrote a piece last week on tracking the 10-year to make sure that even our equity-only clients were paying attention to the bond markets.
Carol, really great to have you with us as always. Carol Schleif, who's a Chief Market Strategist at BMO Private Wealth. We are just about 10 minutes into the start of cash trading and watching a couple of sectors in particular. Chip and other related stocks there may be moving. We are seeing a bit of downside when it comes to the likes of Hynix there, down by 2%. Tokyo Electron off by almost 4%. Renesas also to that tune as well. We've had a few bits of negative news flow, including AMD, some concerns over the China market, saying its return to the Chinese market is difficult to predict due to uncertainty over licenses and declining to predict Chinese sales of its key AI processor that was designed for that market. We're also seeing the sort of response to Taiwan arresting 6 people in the TSMC chip tech probe as well. Watching pharma stocks, as we've heard a little bit more from President Trump in terms of the tariffs, not just on pharma but also on chips as well from the US, will be announced within the next week or so. Previously, he had said that the pharmaceutical tariffs would start off small but could increase to 150 to 250% because they want pharmaceuticals to be made in the US, and we are seeing broad downside there when it comes to some of those Asian pharma names as well. More ahead on the Asia trade. This is Bloomberg.
We'll be putting a initially small tariff on pharmaceuticals, but in 1 year, 1.5 years maximum, it's going to go to 150%, and then it's going to go to 250% because we want pharmaceuticals made in our country.
President Trump there on his plans for pharma tariffs. We're seeing that reaction in the markets at the moment. Let's bring up Bloomberg News Desk editor Dildesis. So let's start off with the pharma threat. He said it'll start off small, but then potentially 150, 250%.
Yeah, I mean, Heidi, I think at this point, this is just the latest in this round of sectoral tariffs that we're really expecting from Trump. In addition to pharmaceutical goods, he's also talked about tariffs on, chips, semiconductor components, that kind of thing. That I think he's still a little bit fuzzy on what exactly those numbers would look like. Obviously, we do have to emphasize this is Trump. A lot of this, has the tendency to kind of change and sort of shift over time. I think at this stage, when it comes to some of those pharmaceutical tariffs that he's talking about, it's really just about seeing what that initial number is and then how much he actually sticks to this idea of hiking rates. I mean, 150%, 250%. We're talking incredibly high tariff rates that could potentially be facing this industry. Very, very industry disrupting. But the one thing that I do also want to emphasize with some of these tariffs that he's talking about, these sectoral tariffs, so the pharmaceutical ones, what he's talked about on chips, is that, a big difference between this and then, say, these other reciprocal tariffs that he's been handing down country by country is that these sectoral tariffs are something that comes out of a Commerce Department investigation, and they're actually much more difficult to roll back once they're in place. So I do think that's one thing that maybe you're looking at in terms of market reaction. But yeah, I mean, again, a lot of uncertainty about this, but that's often the case when it comes to Trump.
And uncertainty as to where we stand with China, but it all kind of sounds like the mood music is positive on, pushing back this deadline, really.
Yeah, so that's the 90-day reprieve that we've got from those incredibly high China tariffs. It does seem like they're pretty well situated to push that maybe another, 90 days or so. So that deadline for that reprieve is supposed to expire on August 12th. So, getting into next week there. I think, when it comes to China, really, the big sort of looming thing in the background is this idea that there could potentially be a meeting between President Trump and Chinese President Xi Jinping later this year. Maybe, in Seoul during an APEC summit is a good opportunity to make that happen. Trump did say overnight that, he's not necessarily focused on, wanting to have that kind of meeting. He said, essentially, if it happens, it happens. If it doesn't, it doesn't. But I do think that at least in the broader context of U.S.-China relations, is one thing that, maybe is, kind of that impetus for, having that meeting. Although, I would point out that as part of Trump's larger, sort of campaign to try to pressure Putin into ending Russia's war in Ukraine, he's really kind of targeted the potential for higher tariffs on nations that sell oil that buy oil from Russia. Obviously India being the primary target, but China is also a pretty significant buyer of Russian oil. So I'm not sure how much that might sort of put a wrinkle in some of these talks about a potential truce there.
Yeah, it's really interesting to see if that approach is going to differ when it comes to how they approach that with Beijing versus New Delhi, right? Because they seem to be sticking to a hard line with India.
Yeah, that's right. It's actually really interesting to see sort of those parallels there because, while, obviously we've just had this discussion about a potential pause and, further truce with these China tariffs. India, was slapped with a 25% tariff, last week, going into effect later this week. And it's really, Trump has really seized on that idea of India as a buyer of Russian oil as a significant reason for that. And then obviously we've talked about these threats. He's threatening to, impose even higher tariffs, talking about that oil specifically. I mean, India obviously has made great strides trying to get lower rates. They were really one of the first out of the gate earlier this year when they were trying to negotiate fairly low rates from the Trump administration. Obviously, that hasn't panned out, and they really have become, sort of this collateral damage in Trump's ultimate push to try to put pressure on Putin. Where we kind of go from here, we'll have to see whether India is successful negotiating there. But yeah, I mean, at this point, mood music not very positive at the moment, and we're still kind of waiting to see what exactly Trump's threats of higher tariffs that could impact India will ultimately look like.
Bloomberg News Desk editor Jill Desis there. And to that point, Bloomberg has also learned that Russia is considering that concession to President Trump, possibly in the form of an air truce with Ukraine to avoid these secondary sanctions. But also say President Vladimir Putin won't agree to a general ceasefire as his forces continue steady advances in the battlefield. Our Bloomberg editor Michael Heath has been following these developments for us. So there's obviously the bigger question as to whether these conditions are going to be acceptable to the US, to Ukraine and its allies, right? But what do we know?
Well, the news coming out of there is that, or what we've been told, is that Russia's prepared to consider an air truce. So they've been conducting a pretty severe bombardment of Ukraine and its cities, and there's been a lot of damage, a lot of injuries, there's been deaths as well. So I mean, if that is the case, it would be positive. But it sort of just comes down to how hard the US wants to push this. I mean, it's reasonably clear that you wave the big stick and you'll start to get a response from Russia, even though it's not talking about a truce or a ceasefire, and it intends to keep prosecuting the war. There was an interesting line actually in our reports from Trump where he says he has these very nice, very polite conversations with Russian President Putin, and then the next night finds out that he's bombed another city and stuff like that. So Trump seems to be cottoning on to the dichotomy of Putin, and I guess to some extent feels like he's been played by the Russian president. He did think that he had this sort of relationship with him, but at the end of the day, it's just, how strong is the US's will? Will it push Russia to actually go for a ceasefire and implement these sanctions? Because oil is the lifeblood of the economy, and that's why Russia is moving. So, we'll just have to see how that plays out.
We're also watching the situation in Gaza. We spoke yesterday about Israel working on this new strategy. Apparently part of it seems to be a full takeover of Gaza. I mean, what happens from there at a time when we're getting more and more nations mulling the idea of recognition of Palestine as a state? Yeah, look, I mean, the pressure's mounting, isn't it? And just the images, it seems, that everyone's seeing of Gaza, of the malnutrition and starvation we're sort of getting to now. And yet, when you listen to the Israeli government, it doesn't seem to be having much of an impact there in terms of them talking about a military takeover of the last 25% of Gaza. What the end game is, I mean, they seem to still be clinging to this idea that you can free hostages militarily, which doesn't seem to be, there's been no sign of that. Every release has been negotiated. There's been a couple of accidental situations, but nothing substantial like that. So where to for peace is really difficult to know, especially, as you said, you've got France, Britain, Canada, even countries like Australia seem to be inclining towards this as well. So, I mean, while they've got the US there, they can probably withstand this pressure, but at some stage they're going to have to talk. And Hamas the same. I mean, Hamas is just as recalcitrant in terms of the negotiating process there. So we're in a bit of a deadlock. But Israel is supposed to have a meeting later this week that will determine its policy. So looks like the military option will continue. Bloomberg editor Michael Heath there. More ahead here on the Asia Trade. This is Bloomberg. President Trump says Scott Bessent doesn't want to be nominated to succeed Jerome Powell as the next Fed chair. Trump told CNBC that Bessent says he wants to stay on as Treasury Secretary, also saying that a decision to replace the Fed governor will be made this week.
Fed governor. I'll be making that decision before the end of the week, and we'll either decide on one for permanence or the 4-month period, the term. There's a term of about a number of months. We have a couple of candidates. Everybody wants it, okay? It's not a couple, but we've narrowed it to a couple of candidates. And we've also, we're looking at the Fed chair, and that's down to 4 people right now.
Well, quite a bit of consternation when it comes to how investors are feeling about that uncertainty. But take a look at what we're watching at the moment. Pretty flat trading when it comes to the Bloomberg Dollar Index. The S&P futures also just modestly to the downside. This, of course, as we continue to see the sort of mulling over the string of weak data we've had from the US and what that potentially means when it comes to expectations for earlier than expected or steeper than expected Fed easing as well. Also watching Treasuries given the move that we've seen in the markets over the last sort of a little while, but there is sort of some concern over some political bias in the data, of course, after we saw the Bureau of Labour Statistics head being fired and some of these concerns over the politicisation of the Fed as well. Watching the likes of CPI-linked bonds as the most direct response to that. Take a look at how we're shaping up when it comes to the European Open as well. European stocks looking like to reflect some of the caution that we've seen here in Asia, which has been a mixed picture so far. But Stocks 50 futures modestly higher than the euro, also trading a little bit higher to the US dollar at the moment. Watching the situation when it comes to Switzerland and the reaction in the Swissy as well, as the Swiss president has arrived in Washington in an attempt to try and court the White House and sway Trump into giving a better deal to lower that 39% tariff that was imposed by Donald Trump last week. They're really under pressure to make a lot of these concessions. It could include changes to agricultural settings for tariffs, the trade of gold, purchases of US planes and energy as well. A lot of analysts and trade policy researchers saying that Switzerland now has to get quite creative to curb that trade deficit, which has been one of the reasons that we've seen Trump so critical of Switzerland in particular. We're also watching trading in energy markets. Of course, so much that the criticism has also been on the purchases of Russian crude for the likes of India, but also now potentially targeting China as well. That, as well as a possible air truce that has been sort of flagged as something that could appease President Trump from Russia, putting a little bit of upside now in Brent crude prices. New York crude also up about 0.2%. But, of course, we have seen 4 consecutive days of declines in these crude markets, and largely also being driven by the fact that we have seen that determination by OPEC Plus to return supply to the market there. Watching copper after what has been really sort of a frenetic couple of weeks of trading on account of, again, some of these tariff changes, but we are seeing copper prices starting to slip a bit, that unwinding of that key tariff trade. The surge in volumes that we've seen over the past few sessions starting to cool a little bit, about 0.1% lower there as we see those flows still continuing to take place, with traders just unwinding these massive bets on the copper tariffs. More ahead on the Asia trade. This is Bloomberg. AMD shares fell in post-market trading as it warned that a return to the crucial China market remains a work in progress. That overshadowed a generally upbeat forecast for its AI business, as bringing our China correspondent Amin low for the latest. The US reversed earlier rules to allow the export of some advanced chips to China, so this should have played out positively for AMD.
Yes, it should have, but it looks like AMD is really not very keen on giving investors any forward guidance on the potential revenue they could get from re-entering the China market, even though analysts were pressing for more information and more commitment in terms of their long-term forecast during the earnings call yesterday. It seems like there is still some uncertainty around the granting of export licenses for some of its AI processors that it wants to export to China. We know a few months ago, AMD had announced that it would be writing down about $800 million as a result of those export controls, and over $1 billion in potential revenue this year. But so far, it's stuck to its main message that the overall outlook remains upbeat, but it can't really provide specifics, especially in regard to the China market. And this is despite, the strong forecast we had seen in what it announced as its third quarter revenues, easily beating expectations there. The second quarter revenue also above analyst estimates. And despite that, we're still seeing the share prices down about 5 or 6% after hours because of the China concerns really overshadowing the outlook there.
We're also focusing on this story when it comes to TSMC. Prosecutors in Taiwan arresting 6 people suspected of stealing trade secrets from TSMC. What do we know?
Yes, well, we know that the authorities had investigated the 6 people, as well as, according to the FT, also searched the premises of Tokyo Electron, which is a Japanese company that has been supplying this chip-making equipment to TSMC. It's not clear at this point. The authorities are still figuring out if the information stolen had already been shared to any third parties. Of course, it's not clear who the end party is that wants to get its hands on these information, but we know Nikkei previously reported that TSMC had fired some employees in relation to suspicion that they are trying to steal secrets related to the 2-nanometer chip. That is the most advanced chips that TSMC can produce right now, something that they hope to mass produce by the second half of this year. Of course, you think about the context here, TSMC is the front runner among the foundries, and when you compare to the Chinese counterparts like SMIC, they can only produce up to 7 nanometers chips now. So this is very valuable sort of technology that many other companies, aside from the Chinese ones, Intel also trying to catch up with TSMC, the market leader here as well. And of course, against this backdrop, there is also US and Taiwan continuing their trade talks. Taiwan still wanting to lower the 20% tariffs on its goods. It's also trying to avert any potential sectoral tariffs on semiconductors as well. So this could really complicate matters there.
Same time, the US charging 2 Chinese nationals for an export control breach involving Nvidia chips.
Yes, again, it seems like chips is really at the center of this tug of war between the different nations. And here we have 2 Chinese nationals that are being charged for exporting Nvidia chips to China. According to the Justice Department, their phones were searched and they found evidence that there had been communication showing these 2 people were looking to send shipments to China via Malaysia. And they could face up to 20 years in prison, according to the Justice Department. Of course, again, this comes as China had also expressed its own concerns around the usage of Nvidia chips over these calls from the Trump administration to include tracking capabilities in the chips to ensure that they don't fall into the wrong hands. So this, again, an ongoing sticking point between the 2 nations as they just concluded the 3rd round of trade talks with positive momentum on both sides that could potentially be derailed by the latest developments in the chip space.
Bloomberg's China correspondent Min Lo rounding up all those chip headlines and taking a look at the latest when it comes to corporate headlines that we're following. And Nvidia and Apple partner Hon Hai saw its July sales slow by 7.25%, the weakest performance since January as tariff concerns hit electronics demand. Still, Hon Hai is expanding its US server production, betting on big tech, spending more on AI infrastructure. It may also have gained from strong iPhone demand as Apple reported its fastest quarterly revenue growth in more than 3 years. Tesla posted another steep sales decline in Europe as it loses ground to China's BYD. July sales in Germany and the UK fell by more than half from a year ago based on EV registrations. By contrast, BYD's registrations more than quadrupled in each country. The ongoing slump adds to concerns that Elon Musk's political activities are hurting the brand. Bloomberg has learned that Alibaba Group is winding down its members-only stores. Its supermarket chain, Hema, has begun closing premium outlets that require an annual subscription for access. The move marks a strategic retreat from a model that has struggled to compete with the likes of Costco and Walmart's Sam's Club. Yum China's US-listed shares fell despite second quarter operating profit beating estimates, with revenue up 4%. Sales benefited from an all-out price war in China's $80 billion food delivery market as Alibaba, JD.com and Meituan all sought to undercut each other to lure customers. Yum China's cost control efforts also helped maintain profit growth. We are also watching Seven & i Holdings, never far from the headlines, it seems, this company. We're seeing upside of about 1.3% at the moment. This after Seven & i saying that they will open 1,300 new international stores, mainly in the US market, as part of its midterm plan, and 1,000 net new outlets to be added in Japan as well as part of that plan. We have seen that stock falling more than 10% after the falling apart, really, of that alimentation Couche-Tard bid in that takeover proposal. It's still almost 20% lower for the year, but trading a little bit higher at the moment. So we saw the Chief Executive Officer who took over earlier this year, Stephen Dacus, really being under pressure to deliver on a strategic plan to streamline the convenience stores, both in Japan but also in those international markets. The fact that this deal with Couche-Tard has failed has really put further pressure on leadership to reassure investors of that turnaround strategy, that narrowing of the business focus to convenience stores, potentially some divestment of low-margin units, and returning cash to shareholders. More ahead on the Asia trade. This is Bloomberg. President Trump's threats to raise tariffs on India even higher than 25% is complicating today's RBI decision. Most economists still expect the central bank to hold rates, but our next guest sees a 25 basis point cut. With us now is Radhika Rao, Executive Director and Senior Economist at DBS Bank. Radhika, really great to have you with us. So you're sort of against consensus view that potentially we could get a surprise. Would that be in direct reaction, do you think, preempting some of the economic pressure that will come from this trade and oil situation?
Hi, morning. In fact, my 25 basis point rate cut call predates the tariff announcements, and I think the argument that I was trying to make is that inflation has been very, very soft. In fact, the July inflation that you're going to see later this month is going to be below 1.5%. So, at a multi-year low, if not a record low. So, because of that, I think there is ample policy space for the central bank to go ahead and cut rates. We expect about 50 basis points of cuts in the second half of 2025. So I would think that front-loaded action would certainly make much more, you can make a very clear argument towards that. Of course, in the interim, you had the central bank also come out and sound a little bit more cautious. They seem to suggest that transmission will be more important than, cutting rates very aggressively. But then you have now the tariff, angle as well playing in since we last made the call, and through the tariff announcements, certainly, the Indian government, as well the authorities, will be watching that very closely. For the central bank, I guess, any potential downside risks to growth could also be an additional argument to go in the favor of a rate cut. So timing is all in the essence. We still maintain our view that there's going to be 50 basis point of cuts within second half of 2025.
Do you think there is a realistic solution to the standoff between the US and India when it comes to, I guess, the very structural nature of India's energy demand and where it can get it from, if not Russia?
Yes, certainly, we've really seen the tariff announcements go in some cases well beyond, trade and economics and then into the political sphere as well. I think this is going to be an evolving situation. Certainly, the Indian authorities have made a clear case that the large structural energy demand requires, a diversified set of sources. And in the past 3-4 years, Russia has become a big part of the basket. Nonetheless, I think at the margin, you've also seen purchases from the US go up as well. But to reduce a share from 1/3 down to, very little, like, for instance, before the Russia-Ukraine war will take times. But I don't think the government perhaps is looking at cutting it back very, very, fast. In the meantime, I think the tariffs that have been announced already, I also want to make it clear clear, provide a perspective that not all of the entire, or not the entire export basket will be subject to the tariff. I mean, there are some exemptions. Pharma is still in place, electronics as well since April, which will kind of shield part of the export basket from the tariff about 25%. So certainly the Russia risk of secondary tariff because of Russia oil purchases will be something we'll be watching quite closely.
Pharma and chips, though, may still come under these sectoral tariffs that President Trump is considering announcing in the next week or so.
Yes, certainly. I think among these two, the pharma will be quite important from an India point of view. About 40% of Indian pharma goes to the US, so it's quite important a sector. And I think we have seen these announcements come before where the US government has mentioned about pharma being as high as 200%, and then the timeline has shifted since then. But yes, if from a US point of view, certainly purchases from Europe are much bigger in their own basket rather than India. But from an India point of view, certainly India's pharma sector would be, and depending on the company level, some have even higher exposure than what the export basket seems to suggest. So that would be something looking at very closely. Semiconductor, I think exposure is relatively very limited. The other one is, of course, electronics. And for now, there has not been much clarity on whether electronics will come under the purview or not. So among all of these sectors, I would think pharma followed by auto components would be something to keep a close eye on.
How sustainable is the disinflationary spell, do you think, and what could change that outlook?
Yeah, right now, we had recently written a note trying to figure out why is it that the inflation has turned so low. In fact, the last reading for June was very close to 2%, and we again think that July is going to be much lower than that. And food costs have been one thing, apart from base effects that are really pushing inflation down very sharply. There's also economic slack in the economy, which the core inflation, or the core as we call it, seems to be picking up. So these things have really come together to provide a good 6-8 months of disinflationary spell. Looking ahead and looking at some of the past experiences we had, I would say between 2016 and 2018, 2019, it suggests that when you see such a sharp decline in inflation, thereafter about 6-8 months forward, you begin to see inflation picking up as well, again, because of statistical effects. So we see that happening into the next fiscal year, in fiscal 27 in India's case, where we think inflation could go back above 4%. So given this backdrop, hence our argument that as growth requires more policy easing support, it would make a very strong case that we could front load the rate cuts. And of course, because of the tariff situation, we could see some fiscal response as well. There could be some directed support and some export promotion policy being brought forward as well to at least to address the labor-intensive industries. Things like gems and jewelry, textiles, these would certainly require a hand from a fiscal policy point of view. So we do think monetary and fiscal policy are likely to go hand in hand in response to the tariff, as well as generally improving the growth momentum in the economy.
Is the outlook for the rupee sort of structurally lower regardless of what the RBI can do?
So the dollar rupee has been through phases, I would say, in the past 6-7 years. There was a time when dollar rupee was only moving higher. I mean, any scope of rupee correction or rupee appreciation was curtailed. Then we had 23-24, where we saw very minimal movement, volatility in the dollar rupee. It was in a very narrow range. And come 2025, we have actually seen in the first 6 months of the year that the currency has been moving on both sides. It does tend to strengthen as well as weaken. I think the most recent announcement has certainly got to do with a few things coming together. We've got the caution because of the tariff announcements. We have also seen some end-month oil demand, as well as some IPO-related flows, and FPI, which is portfolio inflows into equity, have also been thinning out. So all these factors put together really explain what is happening with the currency at this point, which is that dollar rupee is well above 87. And I think dollar briefly picking up towards 100 was also one factor that gave this boost. Again, if we look further out, our house view is still that dollar is likely to head lower in the rest of 2025 going into 2026, which then makes us a bit more positive on the Asian currencies. Rupee perhaps might be one of the few currencies which might see a very modest scale of appreciation as compared to some, say, North Asian countries. But nonetheless, for the year ahead, going into 26, we still are slightly positive on the currency, attributing what is going on right now to partly cyclical factors which are pushing up dollar rupee towards the 88 mark at this point.
Radhika, always great to chat with you. Radhika Rao, Executive Director at DBS Bank. And subscribers can also turn to the terminal for more on the RBI decision. TLIV Go is your function for the latest updates, plus commentary and analysis from our expert editors. More ahead here on the Asia Trade. This is Bloomberg. Well, Honda will be reporting first quarter earnings later today with a focus on the potential tariff hit to its U.S. profits. Let's bring in a Bloomberg Intelligence senior analyst, Tatsuo Yoshida, for all of this. So what are your expectations?
Actually, Honda's first quarter profit will be down from a year earlier. It's simply because last year is a quarterly high. So currently, Honda's business, motorcycle is very strong. Automobile business is sort of fragmented. Japan, a little bit weak, and U.S. continue to be robust, and China and then Southeast Asia, it's very weak. So all things combined, profit may not exceed last year's record high, but I believe they still continue to deliver the strong results.
Of course, against a backdrop of uncertainty over auto tariffs, right? Are we seeing a change in strategy? Is Honda sort of reacting quickly enough to be able to, protect itself against the impact?
Actually, Honda, among the Japanese auto manufacturers, their localization ratio is very high. Roughly speaking, 60% of their Honda sold in the United States is locally made in United States. So this is much higher than the Toyota's 50% and Nissan's 50%. So Honda already done the job, but Honda is also accelerating the local production and moving some of the models from Japan to the U.S., let's say Civic Hybrid.
How sustained do you think that the fall in demand in U.S. sales is likely to be?
Actually, the total industry demand may slow, but the impact on each manufacturer may be different. That's my belief. For example, those companies with strong products, in this case hybrids, should do better than the others, namely Honda and then Toyota, and then more or less Subaru.
Bloomberg Intelligence senior analyst Tatsuo Yoshida there joining us with a view on Honda. And shares of German auto chipmaker Infineon climbed in Frankfurt as the company said it would take less of a tariff hit than expected while also forecasting stronger margins. CFO Sven Schneider told us more about their strategy in that key Chinese market.
The number one position we are enjoying in China is a very strong one, which we are also defending. How is that possible? First of all, you have to have the right products. Secondly, you have to continuously invest into innovation. And we have here some very good examples on very new technologies, but also on pretty mature technologies like low power, mid-high power MOSFETs, where the next generation brings our customers 20-30% efficiency gains the product-to-system approach, where we are not simply selling pieces and components, but a full system to a customer. These are things which keep us at a distance to international and also Chinese competitors. But you are absolutely right. The speed with which innovation is happening in China on all ends is mind-blowing. We are responding to that very successfully. That's why we are designed in not only in international, but also in the top leading and emerging Chinese OEMs and tier ones. But we have to keep going. And I also have to confess, and that's no news, we have said it repeatedly, there are also certain product categories, we call it commodity products, low power products, where we are losing intentionally market share, given that the business is no longer profitable enough for us. That's also part of the journey, but enjoying the broadest product portfolio is a very, very big differentiator for us going forward.
And another part of the journey is not only innovation for you, it has also been inorganic growth, acquisitions. I'm thinking of Marvell Technologies over in the United States. When you think about the long-term strategy at Infineon and you think about other acquisitions in the future, what kind of category of activity is still missing in your portfolio? Where would that come from?
So first of all, I'm happy to share with you that the Marvell Automotive Ethernet acquisition, after a pretty short time, has received already all regulatory approvals. So we expect this transaction to close in the near future, which is good news. It strengthens our microcontroller business on the automotive side, but also beyond automotive, it opens new opportunities for Infineon in adjacent fields like humanoid robots. So that's very positive. M&A is always and has always been an important part of Infineon's growth journey. International Rectifier, Cypress, GaN Systems, Marvell, and we will keep looking into opportunities. They have to fit, of course, clear criteria, strategic fit, financial fit, very important cultural fit, because you know many transactions are healthy and good, but they do not materialize because culturally it doesn't work together. And of course, we are looking into areas, for example, to mention sensors or software, where it could be interesting to enlarge our portfolio even further.
Infineon CFO Sven Schneider there, speaking with our colleague Oliver Crook. We will be watching, of course, some of these key sectors, particularly when Taiwan comes online, watching TSMC given some of those developments there. Also AMD's China market woes as well as, of course, these expectations that we'll see announcements on sectoral tariffs from President Trump and the White House pertaining to chips as well as pharmaceuticals. Also watching China assets as they start trading, given that President Trump has said they're very close to extending that trade truce.